Okay, I really don't like doing this, but make no mistake about it, the stock market is absolutely going to crash. And if you're an investor or you're considering investing, you need to hear me out on this because I'm going to break down in detail using real data 3 major discussion points that might just save you a whole load of pain and make you a whole load of money. So, what are they? Number 1 is why I can say with 100% confidence the markets are going to crash. Then I'm going to show you the data points telling me the risk of an imminent crash is increasing exponentially. And then finally, I'll tell you my 4-step plan I'm already executing on to not only protect myself during this crash that I'm predicting, but to allow me to benefit from it so that I come out the other side a richer man than when I went in. So how can I, an investment banker, say on record that the stock market is going to crash? Well, because I never said when it's going to crash. I just promise you that it will. And actually later on in this video, I'll give you my timeline for when I think that will be. History shows that this isn't speculation, it's a statistical certainty. You've got the Great Depression in 1929, Black Monday in 1987, the dot-com bubble in 2000, financial crisis 2008, COVID in 2020, and they're just the main ones. The reality is, by definition, we never know when a black swan event is going to hit, but the last 70 years of data tells us on average, markets decline by at least 10% every 18 months, and by at least 20% every 6 years. And all research I've been doing on the current market tells me we're not too far from another one. So I'm going to talk you through the 3 alarming metrics that are all flashing red, suggesting the market is balancing on a knife's edge. Number 1 is the worrying trend we're seeing in the S&P 500, which has been creeping up on us for the last 10 years, where the concentration of the largest stocks has increased to unprecedented levels. The dark blue line of this chart shows the concentration of the 10 largest stocks in the S&P 500 from 2000 to 2025, with it now sitting at 40% of the index. Let that sink in for just a minute. The top 10 companies are almost the same size as the next 490 combined. Even during the height of the dot-com bubble, a time renowned for being one of the most exuberant frenzies in the history of the stock market, the top 10 concentration was almost half of what it is today. Don't get me wrong, these companies are fantastic businesses, and I believe they will continue to grow. But their share of the overall market is not sustainable. I mean, look at Nvidia, right? It's now got a market cap larger than the GDP of some global economic powerhouses. Let me put this into perspective. We're talking Japan, Germany, India, United Kingdom, France, Russia. In fact, it's got a higher market cap than the GDP of every country in the world except US and China. And before anyone says I don't understand the business and I don't understand the potential of AI, I made a video back in 2022 saying Nvidia was undervalued. Well, the stock is up over 1,000% since then. But the whole point of an index is to diversify and benefit from spreading your investment across a huge basket of companies. If a few companies perform badly, the saving grace has always been there are hundreds of other companies that you're invested in that will hopefully pick up the slack. The issue is the benefit of diversification decreases as the concentration of your investment increases. In isolation, it's dangerous. In conjunction with the other alarm bells I'm about to run you through, it's a car crash. Number 2 is valuations, but not in the way that you typically know them. I'm not talking about a single metric of valuation, which is liable to manipulation. I'm talking about multiple data points all suggesting the same thing. The first warning sign is in the Shiller PE ratio, which basically takes the price of an index and divides it by the average of the last 10 years of inflation-adjusted earnings. It's a better measure of valuations over time compared with standard PE, as it smooths out booms and busts in a typical economic cycle, and it also accounts for the huge level of inflation fluctuation we've seen in the last few years. The higher the number, the more expensive the index is, and the more likely there will be a correction in the near term. Right now, the Shiller PE sits at 40, higher than any point in recorded history, except for the dot-com bubble where it was 44. But look, the Shiller PE ratio isn't perfect because it looks at, only historical earnings and doesn't take into account differences in forecasted growth. And maybe we're just experiencing or expecting more growth than we've ever seen historically. So I also analyzed the forward PE ratio, which takes today's price and divides by next year's expected earnings, and the result is just as concerning. The forward PE ratio of the S&P 500 is sitting at about 23, compared with an historical average of 17. In fact, the only time it's ever been higher was, you guessed it, the dot-com bubble, where so long as a company had .com in its name, it was valued in the billions, a little bit like how every company is suddenly a master of AI. Every single metric I analysed, from P ratios to EV to EBITDA multiples, even the Warren Buffett indicator, they're all flashing red. High valuations made sense a few years ago when interest rates were near zero, because there was nowhere else to put your money to get a return. As interest rates have increased, the equity risk premium, which is the additional return investors look for when investing in equities versus bonds, hasn't increased with it. To put that more simply, investors are settling for a lower return during a time of higher risk. It completely goes against the fundamentals of all economic theory, which brings me on to concern number 3. The final metric, which is the macro, the precarious state of the global economy, especially in the US, which has a bigger influence on the global economy than any other nation. I could point to a number of red flags, but I don't want to make this more complicated than it needs to be. This chart shows the US government debt as a percentage of GDP, which has continued to increase over time. But that in and of itself isn't necessarily a problem. So I need you to look a little closer to understand the context why the current position is an issue. Take a look at the sharp increase between 1985 and 1995. Why was that not an issue? Because interest rates decreased from around 10% to 5%. So the servicing cost per dollar borrowed was cut in half. The percentage of debt increased dramatically again from 2007 onwards. So why was that not an issue? Well, because again, the debt became cheaper. In fact, it was so cheap, it was almost free. The reason why this time it's different is because the jump from 2020 onwards coincides with a massive increase in interest rates, which have remained elevated for way longer than anyone was anticipating. We've gone from debt being so cheap that it's basically free money to around 5%. That's a massive issue, with forecasts suggesting the government is going to pay over $13 trillion in interest over the next 10 years, stifling opportunity for investment in business and true productivity. All of this, for me, shows how things are starting to align for a correction in global markets, especially the US. I can't be sure of when, clearly, nobody can, and it often takes an unforeseen catalyst for a sharp decline in markets, but to put my money where my mouth is, I'm calling a correction to the US market within the next 12 to 18 months. If I'm being honest, I actually think it will be sooner than that. And here's my 4-step plan to defend against it. The first step is the simplest and yet most difficult at the same time. It's to continue my pattern of investing regularly, and then to invest even more aggressively when markets start tanking. I've already explained in detail in previous videos how time in the market beats timing the market, so you'll have to trust me on that. Next, I'm slowly reducing my US large cap tech exposure. To be clear, I'm not selling anything, but instead of buying the S&P 500, I'm buying the FTSE All World instead, which over time will slowly reduce how much of my portfolio is exposed solely to the US. The global trackers are still like 60% US weighted, and I'm not about to bet against the US by removing that, but the rest of the world provides a bit of a hedge against a US-driven correction. The third thing that I'm doing, which is probably a little bit more interesting to you, is buying more defensive stocks. And by defensive stocks, I mean stable, mature companies that provide essential, or at least quasi-essential, goods and services. They are generally low growth, but they generate tons of profit and free cash flow and are cheap by traditional metrics. The idea is that I hold these stocks during the difficult times because they're less susceptible to huge drops, and then sell when times are good. So one example of a stock that I've spoken about on this channel for years is British American Tobacco. It's a market leader, huge moat, highly profitable, predictable cash flows. There's a reason that that stock is up 50% this year. It's a sign that investors are fleeing to safety. And the final, most important step of all, and this should apply to absolutely everybody, when the crash hits and panic selling grips the market, you stay calm and hold your core positions. Historically, more money has been made during a crash than at the peak, and I'll be right there with you, investing all the way through it.